Yes, thank you very much, Taxmann team. And thank you to all the participants who have joined on a lovely Saturday morning. We have about 1 hour to cover all the amendments. There are quite some amendments. A batch of the amendments came in during the amendments that were moved by the Lok Sabha also. I will deal with all of them. The focus of today's presentation is to take you through the international tax and transfer pricing provisions specifically, which are coming out of the Finance Act 2023. Without much ado, let us start right away with it. Yep. Okay. Just one moment. I will hide the floating panel. Yes. Okay. The first amendment that we'll be talking about is pertaining to the gifts that are made by residents to one, non-residents, and second, resident but not ordinary resident. So you may remember that in the recent past, there was an insertion of this section 918, wherein it was deemed that any sum that will be paid by a resident to a non-resident will be deemed to accrue or arise in India, and that will accordingly be taxed under section 56 to 10 in the hands of the non-resident. So if you read the memorandum and go through it, it was mentioned there that whenever these gifts were made in the past, it was claimed that the income never accrued or arose in India. It was never received also in India. So therefore, it did not fall within the tax net. In order to plug this gap, the CBDT, an amendment was brought by inserting section 918 to this effect. Now that has been extended to gifts made to RNOR also. So let us see in which situations really this amendment can come into play. So as we all know, under FEMA, actually one resident is not permitted to make a foreign currency gift to another resident. So therefore, we have to assume that though under the tax law, that is the Income Tax Act, the person may qualify as a RBUT NOR, but still under FEMA, that person needs to be a person resident outside India. Only then this provision is workable. Otherwise, if a person resident in India is making gift to another person resident in India under FEMA, then that's a clear violation that is not permitted, and then this provision fails. So therefore, let us assume in which situations, let's try to find out in which situations a person is a RBUT NOR under the income tax law, but a person resident outside India under FEMA. So two typical situations that came to our mind when we are examining these provisions. At the time, these provisions were proposed to be introduced by the Finance Bill 2023. One situation is when the person is actually residing outside India in order to qualify as a person resident outside India of FEMA, but they still qualify as a R but NOR. Classic situation could be, say, this is under section 61A. This is a deeming section that was brought in. Under this section, typically the taxman tried to tax the stateless persons. So person who are not qualifying as a tax resident of any country. So therefore, they brought in the words, if a person is not liable to tax in a foreign country, then, and obviously there is a threshold of 15 lakh income that is arising in India, then that person will be deemed to be a resident in India. But again, that person will become a R but NOR. So this is one classic situation under section 618. This could be a situation, say for example, persons who are staying in Bahrain. Where India does not have a tax treaty. See, where India has a tax treaty and that person is able to procure the tax residency certificate, then in that case, obviously there is no question of that person becoming a R but NOR. That person likely in the tiebreaker test would become a tax resident of a foreign country. So therefore, this is one situation that came to our mind. The second situation is, yes, that person is a R but NOR. Person is staying outside India, but not eligible for TRC in the country where they are residing. So let's take for an example, a classic case where a person is staying in UAE. Most of our diaspora, which were targeted under Section 61A, were in the Gulf region. So let's take for an example, a person residing in UAE. In that case, if you see the India UAE DTA, okay, there is a clear provision which says that that person has to stay for more than 183 calendar days in the state of UAE. Only then that person will qualify as a resident under Article 4. And if that person satisfies that situation or the condition, then that person is eligible for TRC and they will be issued rightly so in that country. Now, take for an example, in order to qualify as a resident under Section 61, under Section 61C, explanation 1B, if that person is coming for a visit to India, then we all know that the condition of 60 days gets converted into, now it is 120 days if the income is exceeding 15 lakh rupees. So if the stay is between 120 and 183 days, then that person will become a R but NOR. So that means that person is staying for more than 183 days outside India. But this person is not staying for 183 days in UAE. That person may be traveling. Okay. So let's say that person is spending 170 days in India, 20 to 30 days outside UAE. Then in that case, that person will not qualify as a resident under India UAE DTA, will not be eligible for TRC as per the India UAE DTA. Okay. Now we all know that there was an amendment that was brought out by a cabinet decision in UAE, which mentioned that if a person is holding a residence permit in UAE and has a permanent place to stay there or is on employment and stays for more than 90 days, that is a minimum criteria, then that person is eligible for TRC under the UAE law. But mind you, if you read carefully, that cabinet decision itself mentions that if there is a treaty entered into by UAE with the other treaty country, and there is a condition which is different from that condition, then that condition has to be respected. So therefore, under India UAE DTA, if a person is not staying for more than 183 days calendar year in UAE, then that person will not be eligible for TRC. In that case, that person will become R but NOR. And then if any gift is made by a person resident in India to that person, then this provision will get attracted. And that person will be hit by the deeming provisions. So this is as far as the first provision that I wanted to cover. Okay, so since this webinar is not interactive, you may please send in your questions via chat. As and when, if I get to take a 2-minute break in between, then I will obviously answer them. Otherwise, obviously, time permitting, at the end, I will try to answer all the questions. Next, we go to the angel tax provisions. This is something that has been haunting all the startups. You may see that in this year, there has been hardly any unicorn that has come out of India. Obviously, there is a funding winter. That is the term that is used in the VC world. But apart from that, obviously, there is also the fear of the taxman knocking on your doors by invoking Section 56 to 7B. We have all witnessed what has happened in the past, scores of judicial precedents on the criteria of how the valuation needs to be done, whether the AO can tinker with the valuation, he cannot, he's prevented. I have a slide which is dealing with the judicial principles that are emanating from these judgments. But coming to the basics of this section, why was this section even brought in? This section was introduced way back in 2012. Why? In order to prevent the generation and circulation of unaccounted money that was coming in the garb of share premium. And specifically, it was coming in closely held companies in order to avoid scrutiny. So say suppose if the fair value of the particular equity share of an unlisted company is say 100 rupees, but the foreign investor or the Indian investor, whoever it may be, that investor invests at 10,000 rupees. There is a huge share premium and without any fundamental assumptions, then in that case, it may lead to an allegation that there is unaccounted money that is coming in the form of share premium. So in order to capture those situations, 56(2)(7)(b) was brought in. But what happened as a collateral is that the entire startup industry was thrust upon with these angel tax provisions and was harassed left, right, and center. CBDT had to come out with scores of circulars and instructions that in genuine cases, wherever a valuation report is present, is justifiable, you may not be able to do that. And consequently, over time, there was a criteria that was mentioned that if it is a recognized startup, recognized by DPIT and registered with DPIT, then in that case, this provision will not apply. So that was a exception that was made to this provision. Okay. If this provision is attracted, then the valuation needs to be done as per Rule 11 UA. Which are the situations which are exempted from the purview of this section? One, if the investment is made by a VCC or a VCF, or category 1 and 2 AIF. Category 3 is typically not mentioned because category 3 are hedge funds which invest in liquid listed instruments. So therefore, if the investment is made by fund, it is assumed that there is no hanky-panky and therefore this provision would not apply. Second, if the investment is invited by a startup which is registered with DPIT, and mind you, there are certain provisions here. Okay, there are certain restrictions and conditions that need to be satisfied by that startup, and only then there is an exemption that is provided from the rigors of this provision of section 60 of 56(2)(7)(b). Here, there is a notification of 2019, which lays down a host of conditions. The important ones are that the total paid up capital after counting the share premium should be less than 25 CR. Now, in today's times, if the startup goes beyond Series A round, okay, the paid up capital and share premium very well may exceed 25 CR. Therefore, then those startups, as they grow, even though under DPIT, if a startup is supposed to be registered, there are some base criteria that you should not touch the revenue of 100 CR. And some other criteria are there, but then this condition hits in. This condition is specifically for 56(2)(7)(b). Okay, this condition may not be there for 80IC, but specifically for 56(2)(7)(b. If you do not satisfy this condition, then you are not exempted from provision of angel tax, and then you are hit with this section. Obviously, there are some other sections also. What kind of investments are prohibited? These are general ones, but the most important that is hitting all these startups is the threshold of 25 CR. A lot of representations have been made. Let us see in the near future if any clarification comes in on this point, or if this threshold is indeed increased, because this has been asked since a long time from the startup industry. And if you see those conditions also, this 25 CR as of now does not include the share premium or the capital that is coming in from non-residents. Now, with this amendment of Finance Act 2023, very well that condition may also be modified, and any and all investments of into share capital and including share premium by the non-residents may very well be included. What is the change? The change was that there was an exemption for investments that came in from non-resident investors. Okay, so this provision was only applicable for investments made by resident shareholder. Now, with this change, it has been stated that this provision is now also applicable to non-resident shareholder investments. Okay. Let us see some of the interaction of the criteria which are given in 56(2)(7). What does it say? If the investment is exceeding the face value as well as the fair value. So therefore, if the investment is coming in at face value, no angel tax. Okay. This is a section which has wide applicability, not really restricted to the startup sector. But since there was a lot of difficulty that was faced, a lot of media attention also on these provisions. The term angel tax was coined. If the investment is made, that is issue of shares are being made between the fair value but below the fair market value, okay, then in that case also this provision does not come into play. So therefore, only if the investment is made at more than fair market value, then the difference, if it is exceeding 50,000, in that case, this section will come into play. Which are the methods by which one can determine the FMV? One, you can go by the book value method under 11 UA 2A. You can go by the DCF method under 11 UA 2B, very widely adopted by the startup industry, because the investment is typically at a huge premium, which can only be justified by the DCF method, and therefore there a valuation by a merchant banker is required. And third, but hardly used provision, if you don't want to go for rule 11 UA, then you can do your own valuation. If you can justify to the AO based on the value of your assets, and there you can also include the value of your intangible assets. These are the three alternative methods by which you can determine the FMV. In that case, what is really the implication? I first deal with this. The real implication here is that for non-residents at least, there is a clear dichotomy between provisions of two laws. Under FEMA, it was always stipulated that whatever investment comes in, the issue price has to be greater than or equal to the fair value. So say suppose as per the valuation report, the fair market value is 50 rupees, that is 50 INR. Then the issue of the shares cannot be made at a price which is less than 50. But now under the income tax law, it says that if the issue price is if it is greater than the fair value. So say suppose an investment is made at 75 INR. Okay. So therefore there is a difference of this 25 multiplied by the number of shares. So say, 1,000 shares have been issued. Okay. Or say maybe 1 lakh shares have been issued to all the investors in a particular series round. And in that case, obviously the consideration is exceeding 50K. And in that case, the difference will be brought to tax under the income tax law. Now, there is also another law, that is under Companies Act, where a registered valuer needs to issue a valuation certificate. And there again, the valuation criteria is that the issue price has to be greater than or equal to the fair value. So under two laws, it is the same. But under a third law now, that is under section 5627B, it is clearly contrary to what the other two laws state. So therefore, now there is a clear dichotomy on what to do. Okay? Everyone was expecting at least by the 1st of April, certain clarification would have come in. Really don't know why it is held up, because this is something that has been brought to the attention of the Finance Ministry long back after the proposed amendments White Finance Bill were introduced. Really don't know what is holding it up. Okay, coming to the second point. The second point is obviously 5627B applies for issue of shares. Now, issue of shares could be issue of equity shares or issue of CCPS. Okay, so either you issue equity shares or you issue CCPS, you still need to adhere to the provisions of this section. Now, what about conversion? What at the time of conversion? If the CCPS is converted into equity shares, or if the CCDs are converted into equity shares. Logically, if you ask me, this provision should not apply, because at one point in time, we have already complied with section 5627B. At the time of conversion, there is no inflow. Okay, there is no consideration per se. Consideration was paid at the time of issue of CCPS or CCD. So therefore, at the second stage, at the time of conversion, if there is no additional consideration, then this section should ideally not get attracted. But recently, the decision, I think it is Calcutta Tribunal, in the case of Milk Mantra, that took a divergent stand. It said that the ITAT, it said that consideration is not only cash consideration. Consideration is also non-cash consideration. So there it was a situation of conversion of CCD into equity shares. So it held that there could be a lot of non-cash consideration coming into play at the time of conversion. Now, what could be the non-cash consideration? One, there is no obligation to pay interest. Second, the debt equity ratio becomes comfortable. It increases for the issuer company. So that is a non-cash consideration. Another is that the probability of going bust reduces. So that is also another non-cash consideration. And similarly, there are certain non-cash considerations coming out of the CCD agreement that were highlighted by the tribunal. And then it said that yes, though there is no scope for a cash consideration coming in at the time of conversion, but still there are elements which point to non-cash consideration that are received by the issuer company, and therefore at the time of conversion of CCD into equity, again the provision of 56 to 7B have to be complied with. So in my view, I would not agree I do not agree with the logic that has been stated. These are all terms which are agreed to with the investor at the time of issuance of the CCD. So therefore, these are all considerations that were already factored in at the time of issue of CCD, and therefore the valuation at that point in time was tested. Then there is no scope for again taking into consideration 56 to 7B at the time of conversion. Now all these factors, the probability of default, the higher debt service cost, all these factors really do not come into play at the time of conversion of CCPS into equity. So therefore, one may still want to distinguish this decision when it comes to conversion of CCD into equity shares. And then one may still hold that, yes, there is no scope for applicability of 56 to 7B at the time of conversion of CCPS into equity shares. Now, what are the judicial decisions talking about, and what are principles emerging therefrom? One important and the most important principle is that the AO has no right to change the valuation method. Okay? The AO can go deep into the valuation report. Obviously, it is always the onus of the SSE to provide details that the AO has sought. Okay. Obviously, also to prove the correctness of the report, to provide details about projection, discounting factor, terminal value, all the scientific evidence that has gone into valuing the equity shares. And the AO can scrutinize that. Okay. But even if he is not satisfied with the SSE's explanation, after the SSE gives the explanation not satisfied, he cannot reject the method. Okay. Under the same valuation method, though he can record the reasons for not accepting the SSE's explanation, and he can obviously alter the valuation, but he cannot change the method. Okay. Second, for scrutinizing the valuation report, it is not an ex ante examination. So therefore, even though the AO at the time of assessment will be looking at all the data, he cannot sit into judgment of the valuer and cannot say that no, I will take the numbers that have actually appeared in the financial results, and I will not go with the projections that were appearing at the time of valuing the equity shares or the CCPS. So therefore, the data that was only available at the time of valuation needs to be considered. In the future, okay, looking back, the AO cannot replace the future figures against the figures projections that were taken into account for issuing the valuation report. There are some of the judicial decisions over the years that have laid out certain principles. Okay. So that is everything that was dealing with the angel tax. We go to the next provision. Really not a substantial change other than the change in the timeline. Under 92D3, during the course of assessment, the TPO may ask for the study report Previously, there was a time period of 30 days that was afforded to the SSE. And even if after giving the opportunity of these 30 days, if the SSE required additional time, he or she or it could have asked for extension of another 30 days. Now both have been reduced to 10 days. So the time period under 92D3 is also being reduced to 10 days. That is after receipt of the notice. And even if the SSE seeks additional time, that is also restricted to another 10 days. The next change that we go to is the change brought about in the SEZ provisions under section 10AA. A specified percentage of profit is exempt for SEZ units. There, until now, what used to happen is that there was no time period that was stipulated. So we know that under the FTP, under GST provisions, under FEMA, there are time limits that are mentioned. Okay, if you do not bring the export proceeds within the time limit, then there is a violation under FEMA. You will have to reverse any or forego any export incentives, and obviously you will also not be eligible for the GST benefit. But still, the SEZ units were eligible for section 10AA benefits because there was no time period that was mentioned here. So there was a CAG report which flagged this, and they recommended to the CBDT that please prescribe a time period to the SSEs for availing the section 10AA benefit. So therefore, now there is a time period that has been stipulated, which is 6 months from the end of the previous year or such other period that the RBI may allow. If you are bringing in the export proceeds in convertible foreign exchange within that period, then you are eligible for the benefits under 10AA, otherwise you will not be eligible. Okay. Now, this is bringing into India. Now, under FEMA, there are certain provisions which allow an exporter to receive the export proceeds into a foreign bank account. Okay. So you have to apply to RBI. There is some form EFC in which you have to justify that there is a foreign exchange outgo also. So you are importing as well as exporting, and therefore make a case out to RBI that please allow me to maintain the foreign exchange, foreign currency account, but I don't want to incur the transaction cost as well as the currency conversion cost. So then in those cases, RBI allows the exporter to maintain a foreign bank account. If the export proceeds are received in that foreign bank account, then in that case also, this provision would be satisfied if the time period of either 6 months or the one appearing under FEMA is satisfied. Now, there is a corresponding change also made under 155(11)(a) because in the year in which, that is in the previous year in which these export proceeds have been received, and then in that year, obviously the benefits should be afforded. So therefore, a consequential amendment in 155(11)(a) have also been made. Now, what is the period which is there prescribed under FEMA? So under FEMA, it is 9 months from the date of the exports. Or if you are asking for an extension, any exporter, if they are facing difficulties in realization, they may seek extension from the AD for a period up to 6 months at a time for a maximum of 3 years. Then in that case, that period will apply. So therefore, it is either of 6 months from end of FY. This is under income tax law. This is under FEMA. And this is also under FEMA. So you still need to see all these timelines because under 10AA itself, it has been mentioned that any other time period that is allowed by the competent authority or the competent authority being the RBI. So all these time periods you need to check in order to see whether you are eligible for section 10AA benefits in that particular previous year. If not, then you become eligible in the year in which you bring back the export proceeds. Okay. We go on to the next provision. The next provision is dealing with the interest deductibility. So BEPS Action Plan 4 brought about a change in the scenario wherein if there was a debt push down from the parent level or the overseas company level into the India company level, wherein excess interest was paid and profits were extracted by way of the interest payments. In that case, there was a base erosion and profit shifting that was happening, and therefore it recommended that under the domestic tax law of the country, these changes need to be brought out. Pursuant to which Section 94B was legislated, which stated that if there is an interest expense which is exceeding 30% of the EBITDA, and that is paid to a non-resident associated enterprise, either by the Indian company or by the P of the foreign company. So it is either branch office to head office or branch office to a associated enterprise of the head office. In that case, whatever excess is there will be disallowed and that will be allowed to be carried forward, okay, for a certain number of years. Now, obviously, keeping in mind the nature of the banking and insurance industry, there was an exclusion that was given from the rigors of this provision, and that is by way of Section 94B3. Now, there were representations made by the NBFC industry that our activities are also similar in nature to the banking industry. So therefore, please grant us also an exemption from these provisions. This is obviously in case where typically ECB is borrowed. So therefore, acceding to their request, White Finance Act 23, now 94B3 has also been extended to specified class of NBFCs that will be notified by the government. So the question comes up that when it comes to banking and insurance industry, it is all categories of companies that are operating here. Okay. So if it is an Indian company, Indian bank making payment to a foreign, it is a foreign bank's branch making payment to the head office. But when it comes to NBFCs, they are restricting it to specified class, though the specified categories have not been mentioned. But why is that so? That is so because not all categories of NBFC carry out fund-based activities. So let's say for an example, there is an NBFC category, aggregator license. In that case, you are only aggregating the data, that is the financial data from different sources, and wherever any financial institution requires access to the data, you will provide that. In that case, there is no relation, no connection with handling of the funds, and therefore such classes of NBFCs really there is no point in exempting or excluding them from the provisions of Section 94B3. And that would be one of the reasons why it is restricted to only specified class of NBFCs. So this was the provision relating to interest deductibility. We come to the next important provision, which has made a hue and cry in the overseas investment industry, in the overseas travel industry, and obviously in any other cases where there are LRS remittances involved. Now, in recent past, you may know that Section 206(1)(g) was brought in to collect TCS on foreign remittances and on sale of overseas tour packages. Okay, so if the remittances are made under LRS, then the authorized dealer had an obligation to collect TCS. If the payments are made for purchase of an overseas tour package, then the tour companies had an obligation to collect the TCS. Till this point in time, it covered foreign remittances. What are the changes? Multiple changes. Changes in the scope, changes in the rate. Okay, so one is scope, second is rate. And talking about scope, obviously the type of transactions as well as where the transactions take place. Earlier it was remittance outside India. Now they have omitted the words outside India. So therefore, it is outside India also, within India also. Now you may ask, which are the LRS remittances that may take place within India? Two LRS remittances that come to our mind. One is when a transfer is made to an NRO account. Okay. Then second is when transfer is made to a bank account opened in IFSC. So these are typically transfers where a gift is made to the NR account. There the limit of $250,000 is attracted. Also, when a rupee loan is given to close relatives, that is when also the LRS limit is attracted. So this is not any and all transfers to NRO, only certain transfers or payments made to the NRO account. Second is when you open a bank account in IFSC for making investments in stocks which are listed on recognized stock exchange in IFSC, that HNIs are allowed to do. In that case, whenever you remit money to the bank account maintained in IFSC, then in that case, it is still considered as a remittance made within India, at least as far as the tax provisions are concerned. Okay. As far as FEMA provisions, it will be treated as a foreign remittance, but as far as tax provisions, it will be treated as a remittance within India. So therefore, they wanted to cover this also. So this is one expansion. Other than that, now certain category changes have happened. So previously, for education loan, for education remittances, that is out of loan, the percentage that was prescribed for TCS was 0.5%. That was in excess of 7 lakhs. There is no change other than for education remittances. So out of say maybe own net worth or gifted funds, there it was 5% in excess of 7 lakhs. Here also there is no change. Okay. It's an important remittance. Don't want to inconvenience students. So therefore they have not tinkered with the limit also, with the rate also. Okay. Now another category has specifically been included. Earlier it came under the general category for the purpose of medical treatment. If you are going, then above 7 lakh, it used to be 5% threshold. So this typically used to be clubbed under this category. So any and all purposes. So that also included medical treatment. It was only and only in excess of 7 lakh. Okay, and that also 5%. Now what has happened is that apart from education, apart from medical treatment, apart from obviously education payments out of loan or out of self network, leaving these categories apart, any remittance, mind you, there is no threshold of 7 lakh. Okay? $1 remittance will also attract TCS, and that also not at 5% tax rate, it is 20% tax rate. So there's a huge inconvenience that is being caused to all the resident individuals who want to make remittances under LRS. Typically, it should have been under the purview of RBI to curb these remittances if there were concerns in some quarters about the huge amount of outbound individual remittances. It shouldn't have come under the purview of CBT to take that step and try to curb these remittances in any way. And coming to overseas tour packages, here there was no threshold. Now there is no threshold, but the rate has increased 4 times from 5% to 20%. Okay. This provision will become applicable from 1st July 2023. So therefore, before that, still the present rates and the present scope will apply. Okay. If the person did not furnish PAN, or if the person was a non-ITR filer, then in that case, the rate would have increased from 5%. Okay, sorry, yeah, non-filer or non-furnishing of PAN, the rate would have increased from 5% to twice the rate. Okay. Now, if there was no change in this provision, what would have happened? So your rate, twice the rate is 10%. Previously, now because of this 20% rate under TCS, 20% into 2, this would have gone to 40%. So they realized that this is abnormally high rate, though they didn't realize that 20% itself is abnormally high rate. At least they brought in a cap of 20%. So even though if you are a non-ITR filer, you do not want to furnish not furnished, then in that case also the maximum TCS rate will be 20%. certain questions come to our mind about TCS in general. Okay, these are not restricted to TCS on LRS remittances. This is typically TCS in general. So if a particular employee is paying TCS, can he ask the employer that, I have made the TCS remittances. Can you please factor that in when you are computing my TDS? The answer is an emphatic no. Under section 192 2B, this is not permitted. Okay. So irrespective of whether TCS has been collected from that particular individual or not, when the employer is considering the TDS on the salary, the employer will not take into consideration that TCS. Is there any provision for a lower or nil withholding, nil collection? It can't be called withholding, nil collection of TCS. The answer is no again. There is no provision which applies for seeking exemption from the TCS provisions. So this is the gravity of the situation and provides a burden on the individuals. Of course, I believe that the constitutional validity of these provisions may be challenged. There is also a counter view. There is a Supreme Court case law where the previous TCS provisions were challenged, but that were obviously based on the argument that it is nothing but a collection of tax on income. Here, there is no income. It is pure remittances that are made. Okay, it does not relate to the income of the remitter. So therefore, sometimes someone may challenge these provisions under the constitutional validity. Okay. Coming to the next important chunk of business trust. So this is where I will take at least 5 minutes to explain what is a change. A lot of changes have come in and we have decoded them for you here. What used to happen is, so let me take you directly into the structures. Very easy to explain with help of the structure. In case of REIT and InvIT, okay, this is the typical structure. I have not considered obviously the investment manager, the trustee, the sponsor, not relevant for the tax purposes here, at least as far as the amendment is concerned. So unit holders invest into units of either InvIT or REIT. REIT in turn invests into either SPV or invest directly into the real estate properties, typically called as assets. Okay. They make these investments at least into SPV by way of debt infusion or equity infusion. Okay. So from the real estate assets, one, a direct rental income is earned by REIT. There is a pass-through as far as the rent income is concerned. So therefore, whenever REIT earns that income, it is as good as the unit holder earning that income. It's a partial pass-through status that is given for REIT and InvIT structures. Why do I say partial? Because only certain incomes that are earned by REIT are treated as pass-through, not all income. We'll come to it. One is rent income. Second is interest income. Interest income on what? On the loans given by REIT to the SPV. Dividend on what? On the equity infusion made by REIT into SPV. Then there is a third component, that is a debt repayment. So if the SPV wants to repay the debt, then the SPV will make a payment to REIT. Now, the provisions of the Act are worded in such a manner. So this is section 1023 FD. Till this point in time, section 1023 FD, it stated that anything other than interest, dividend, rent, everything would be treated as exempt. So even capital repayments, debt repayment, okay, there never used to be any taxability in the hands of unit holders. Similar goes for InvIT. Okay, InvIT obviously we have at least not seen direct investment into project. Typically, it is through project SPVs only. Similar income streams are there. I may not want to classify debt repayment as an income stream, but from an investor's perspective, what he will see, okay, I am getting interest. Okay, I am getting dividend. Now, say suppose I have made an investment of X amount. I am getting amounts A, B, as well as C, that is debt repayment. Now, upon investment of X, I am receiving A, B, and C. At least for X, it is an income. Okay. Between the REIT and InvIT, it may be a capital payment and repayment. But as far as the income that is distributed unit holder, it is still an income. But because the provisions of 1023 FD were worded in such a manner, it never used to be treated as an income. So this is the loophole or the gap that is sought to be plugged and has been plugged by Finance Act 2023. Very simple. This is the intention of the provision. Now, how they have done this is something that will come to. Multiple sections have been amended. One, there is an amendment in section 56.2, and there is a new provision that has been coming by way of clause 12. Okay. Now, this debt repayment, they want to tax under 56.2 12. Okay. How will they tax it? They say that you have to follow this formula. A minus B minus C. What is A? A is aggregate of sums other than interest and dividend that are repaid, that are paid or distributed. So other than that, so that is why special income. And if the trust is taxable on its own business income, then excluding that because there is no pass-through. So aggregate of sums that is typically targeting at debt repayment during the previous year as well as any earlier previous year. We have given here by way of an example also. We'll come to year 1, 2, 3. Then in that case, I will add up all the sums. I will compare that with B plus C. What is B? B is the issue price. So issue price is nothing but the investment amount, that is X, and the amount charged to tax under this clause in the previous year. Since you are taking aggregation of previous year, you still need to see if you have charged in the previous year, then you will not tax it again, obviously, in order to avoid double taxation. So therefore, A minus B minus C. Now, if the issue price is still higher than whatever debt repayments that are coming, then in that case, there is no tax under 56.2.12. But indeed, what will happen is under section 48, against this amount of investment that you have made, the cost of acquisition will be reduced by this aggregate sum. If it is not taxed under 56.2.12, because whatever debt repayments you have received is still less than the cost invested by you, then in that case, whatever debt repayments that you receive, that is amortization of debt, that will go on to reduce your cost of acquisition. After that cost of acquisition has been reduced to 0, only after that, any excess sum will be taxed under 56.2.10. It is as simple as that. Whatever debt payments that you receive, till the point in time they are up to issue price, then you keep adjusting the cost of acquisition. Once the cost of acquisition becomes 0, then in that case, it will be taxed as IFOS. Very simple. So this is what the provision talks about. Consequential amendment made in 1023 FE also, because the exemption was never intended to be taken away by introduction of these provisions. So therefore, that exemption is being continued. No need to withhold. This will come later on in later slide. So if you see embassy REIT distributions, there is a clear element of repayment of debt also that is being made. And there is an opinion that is being given by a professional firm before, obviously, the proposed provisions that this sum was not chargeable to tax in the hands of the investors. Neither section 48 cost of acquisition had to be reduced. So therefore, it was completely exempt. Now these consequential changes are coming. Let's take for an example, there is a unit holder who has invested 2,000 rupees in a InvIT or a REIT. Now, in year 1, that unit holder is receiving 1,500 as a repayment of debt. In year 2, receiving 800. And in year 3, that unit holder has redeemed the units for a price of 3,000 INR. So let us see year wise, what will happen? In year 1, I will apply the formula which is given under 56 to 12. What is the formula? A minus B minus C. What is A? A is the sum that I am receiving other than by way of interest and dividend. So it is 1500. A minus B. B is the issue price. What is the issue price? 2000. A is less than B. Therefore, here there is no taxation under 56 to 12. But what will happen is the cost of acquisition will get reduced by this is year 1, right? Yeah. So year, yeah. So cost, sorry, year 1 is 1500. Okay. So now the cost has become 500. Let's go to the next year. Next year, another distribution of 800 is made. So now the total of the distribution is what? 1500 plus 800 is 2300. 2300 is exceeding 2000. So therefore, whatever excess will be charged here. Okay. Whatever is not charged here will go on to reduce again the cost of acquisition. So let's look at it in a way. First, you go to the cost of acquisition, reduce it by year 1 and year 2 maximum. Once it becomes 0 cost of acquisition, then you go on and tax the excess as 56 to 10, 56 to 12 other income. So therefore, in year 2, there will be other income which will be chargeable to tax. In year 3, there will be capital gains that will be charged to tax. And this will be a long-term capital gain, entire amount of 3000. So this is how these provisions and these amendments will work. Okay. About TDS at the SPV level, there is an exemption which was provided under 194, now provided under 193. 194 was for dividend, 193 is for interest. For repayment of debt, as we said, there is no question of income, at least as far as the trust and the SPV are concerned. Therefore, there is no question of TDS. When there's a distribution that is happening at the trust level, interest is taxable at 5%, dividend is taxable at 10%. This is so everything is coming under 194 LBA. This is coming under, since we are looking for non-residents, this is going under 190, 195. I'm not sure this goes under 194 LBA or 195. In any case, it is rates in force. Rates in force are 30%, 40% for individual or for company. There's only the TVS provisions, but what about the eventual taxation? Eventual taxation, interest, dividend will go under IFOS at the respective slab rates. Rental income, here it is rates in force. When it will become eventual income, that will again go under IFOS. And repayment of debt now covered under 56 to 12. So this will also go under IFOS. Everything goes under IFOS. Okay. Here, obviously, treaty provisions will also apply if it is a non-resident. You can apply treaty provisions and reduce it. This will go under other income article. Okay. And this will go under Article 6. But typically rates are not provided under Article 6. Therefore, we fall back under the domestic tax law. That is how the examination will go on. Now, the last chunk of provisions that are dealing with the financial service sector are the tax incentives that are given to IFSC. So under IFSC, it is financial service sector as well as non-financial service sector, aircraft leasing and some other provisions, tonnage tax. So I've clubbed everything together in the subsequent slides. One is upon relocation of the funds to IFSC, there was a tax exemption that was provided. There was a term which was used. What is the meaning of original fund? What is the meaning of resultant fund? Now, the Abu Dhabi Investment Authority Fund is specifically included in the original fund definition. This is where that fund uses any investment vehicle to invest. Second is amendment in 56 to 7B. If a fund from IFSC is investing into a startup, then these provisions will not apply. Maybe this is something that they want to encourage and that is holding up clarifications in 56 to 7B. Incentives for aircraft leasing. So here there is a exemption that is provided on transfer of equity shares by an aircraft leasing company from IFSC or a non-resident of shares of a domestic company, provided two conditions satisfied. The domestic company engaged in aircraft leasing will commence operation in IFSC before a particular period, and the capital gain arises within 10 years from the commencement of the operations, or this particular period, whichever is later. Again, the dividend income. So this is intercorporate dividend by one aircraft leasing company to another within IFSC, that is exempt. Okay, that is not taxable. Then certain benefits given to OBU. Benefits were earlier up to 10 years deduction was provided. First 5 years 100%, next 5 years 50%. Now it is 100% for the entire 10-year period. The offshore derivative instruments exemption was provided only upon transfer till now. Now even distribution of income, okay, income arising from the offshore derivative instruments, that will also be exempt. What about dividend? Dividend, at least under 115A, there was a tax that was amounting to 20%. Now it will be only 10%. So this is another benefit given under IFSC. This is the foreign currency borrowings and the domestic borrowings. Domestic meaning rupee denominated. In that case, at least for foreign currency borrowings, for IFSC borrowings, it was a 4% rate which was provided. It was rupee denominated or from a foreign company by issuance of a long-term bond. Now this period was expiring on 1st July 2023. So after 1st July 2023, it would have been ideally 20%, but they have extended this period, but at a higher rate. Okay, so any bonds that are listed on a recognized stock exchange or a RDB that is listed and issued after 1st July 2023, the tax rate will be, TDS rate will be 9% instead of 4%, but it will still not be 20%. This is a benefit given. Then under 196A, again, this is coming out of the PILCOM decision. Under PILCOM decision, whether or not sum was chargeable to tax, the DTA, the entire, the TDS was supposed to be made on the entire amount. Here, under 196A, you can take DTA benefit. Under 194 LBA, again, 197 provisions excluded, 194 LBA within its purview. Now that has been included, so therefore, lower withholding tax deduction application can still be made for 194 LBA cases. And this is the last provision which I will cover today. This is nothing but an increase in the tax rate. No controversy that has arisen because of this. It is only the implications that have arisen because of increase in the rate. Till now, section 115A provided that the tax on any royalty FTS would be at the rate of 10% plus surcharge education cess. Now that 10% has been increased to 20%. This was a surprise to all because this was not there initially in the finance bill, but came in at the time of passage of the bill later on. Now, what could be the implications? Okay, no controversy per se. I again reiterate, it's only the implications. The implications is that now it was straightforward under the income tax law. So therefore, wherever the DTA rates were higher than 10%, obviously there was a benefit that was taken of the domestic tax law. Again, there was an exemption for filing. Now, if you want to take the DTA benefits, so say suppose it is 15% in some of the DTAs, then for taking the treaty benefit, again, there is a documentation burden on them. You have to furnish TRC, you have to furnish 10F online. There is a particular period that has been given right now, wherein the online filing requirement has been relaxed. But after that, anyway, online filing will be applicable. So therefore, a foreign company will have to register on the portal for extracting, for filing form 10F, extracting that and sending it to the payer. So for that, they will also have to take a PAN. There is no exemption from that. Okay. So documentation burden has come in under 115A. Even the return filing obligation was not there. Now, if you're going for a DTA rate, return filing obligations will come upon you. For grossing of arrangements, there is additional tax burden. Earlier it was 10%, now it will be have to be grossed up at 20%. So therefore, these are the cases where, certain amount of difficulties will be faced. Still, no controversy at the end of the day. So these were all the provisions that I wanted to cover. And I thank everyone for a very patient hearing and bearing with me throughout. Now, if there are any questions, I can take them up. Sorry, just one moment. I will try to pull out the questions which are there. Yeah, there are quite some questions. Okay. How much time do we have, Taxmann team? Can I take another 5-10 minutes or no?
Yes, sure. So you can take some time.
Okay. Yeah. So I will go through the questions. There is a question by an anonymous attendee. In many shareholders agreement, there are clauses wherein if value is below the last allotment price, then compensatory shares are allotted to existing. Does this attract tax in hands of the existing shareholders when new allotment is made? So this is where typically, if new shares have been allotted, they are typically treated as a rights issue. In the anti-dilution clause, it is typically done at the face value. Okay. So if it is done at the face value, then you go back to the provision and see if there is any tax. Then there is a question from C. Nitin Gupta. For services, time limit prescribed is 270 days, and for goods, there is nothing. If I recall, no, for services, it is again 9 months. So, yeah, so you're right. So that is 270 days. Again, for goods is also 9 months. Then there is another question, another interplay, accounting standard mandates, accounting recognition, so and so based on RBI rate, customs rate is lower than RBI rate, actual realization rate for so and so while drawing out. Please share your views how situation can be dealt with. I think while drawing up financial statements, such impact is recognized as extended fluctuation as per AS as well as ICDS. Of late, show cause notice has been issued for such deviations. We'll have to understand this, Nitin Bhai, from you. We can take this offline. There's another question. NRO account will not be applicable under section 206C as NRO account is for non-resident and LRS is for resident. Okay. So I'll clarify here. Here, what I was talking about is remittances made to the NRO account. So there are two remittances that are typically there. One, which is a loan that is given in rupees to a NRO account. In that case, it is treated under as a LRS remittance, and second, which is gift made, that is again a INR gift. So therefore, this is not a TCS on the non-resident. This is a TCS on the resident. I hope I have made that clear. Then there is another question. A rent paid to non-resident in his NRO account by a partnership firm will be covered under LRS. The answer is no. The firm is already doing TDS. Again, another question from Nitin Bhai. If monies are remitted under LRS with certain purpose code, can it be amended subsequently? Yes, you have to write to the AD bank and you can do it with certain proof. Then there is another question. Does the remittance for education medical have to be made directly to institutions, or can the same be made to individuals' bank account but for legitimate purposes? So typically, it has to be made directly to the institution. But if you make out a case with your AD bank, they may still allow you to do that. Okay. From 24/8/2022, if LRS money is remitted are not utilized or invested, whether money should be brought back within 180 days? The answer is yes. How a time limit of 180 days to be determined? This is time limit from the date of remittance. I think that is pretty clear. Another question. LRS limit $250,000, whether it is inclusive of TCS, exclusive, they said exclusive of TCS. Okay. Now the question, if a travel agent booked package for Indian director of foreign company and invoice raised to the foreign company, then what about TCS? Okay. So if it is a corporate travel, then in that case, I would believe this should not be applicable. Another question, whether TCS would trigger on foreign exchange credit card transaction from specified date. So there was a statement that was given by our Honorable FM that they intend to bring even credit card spends under LRS. It always used to be covered under LRS, but there was no mechanism for either TDS or TCS. So under 195 also, TDS provisions are still applicable if you make a foreign exchange spend on your credit card. Then I'll take another 2-3 questions because there are a lot of questions that have come in. So my question is whether a manufacturing unit can set up in IFSC. No, the answer is no. It's a international financial services center, so therefore a manufacturing unit cannot be set up there. Then there is another question. Can you please mention the case law? The case law is a milk mantra. You can look it up and you can get that. Explain the tax return filing for taking DTA rate. Okay, so under 115A, there was an exemption that was provided. If the tax rate of 10% plus surcharge education cess was adhered to, the non-resident did not have any obligation to file the income tax return. Now, if a person is not going for the 20% tax rate, but the DTA rate which is beneficial, so let's say it is 15% tax rate under a particular DTA. And in that case, the exemption from filing tax return under section 139 is not there, even if you're taking the DTA rate benefit. So in all those cases, the tax return will need to be filed. So I think we have taken many questions. You can also write to me if you have any further questions. I'll be happy to take on a personal basis. So no problem. Thank you very much.